Imagine hiking your prices by like nearly 5% right when your customers are actively complaining about inflation.
Right, they're exhausted.
Exactly. I mean, they are completely exhausted by high gas prices and, they're cutting back on their discretionary spending left and right.
Yeah, the consumer is definitely tapped out.
And in the brutal world of fast food, doing that is, well, it's almost always a recipe for an empty drive-through. I mean, you raise the price of a chicken meal, the consumer hits their breaking point, and they simply stop showing up.
They just go somewhere else.
Right. But last quarter, well, Pollo Loco did exactly that. They pushed an effective price increase of 4.6%. And somehow, miraculously, more people actually showed up.
It is, it's the ultimate counterintuitive metric.
Yeah.
When you look at the broader quick service restaurant industry right now, or QSR as we call it, almost everyone is bleeding foot traffic.
Oh, absolutely.
The $15 fast food burger has basically become this the symbol of macroeconomic fatigue. So when a brand raises prices and simultaneously increases their human foot traffic, well, you are looking at an absolute masterclass in pricing power.
Okay, let's unpack this, because that is exactly what we are doing today. Welcome to a special Talk Tickers edition of the Deep Dive. We are talking directly to you, the retail investor looking to cut through all the Wall Street jargon.
Right, getting down to the actual data.
Exactly. We are taking the first quarter 2026 earnings conference call from El Pollo Loco, ticker symbol LOCO, and we're stripping away the polished corporate PR spin to see the actual financial mechanics underneath.
It's going to be a fun one.
It really is. So we have the transcript from May 7th, 2026, featuring CEO Liz Williams and CFO Ira Filth. And our mission today isn't just to recite the numbers. We want to understand the why and the how behind a corporate turnaround in a really highly pressured economic environment.
And this specific earnings call is a goldmine for that, frankly. Yeah, because it touches on every major pressure point in retail investing today. I mean, we have digital transformation, supply chain management, labor efficiency, and regional geographic expansion.
All the big buzzwords.
Right, but actual execution of them. Liz Williams and her executive team are attempting to take this historically regional, California-centric brand and flex its muscles on a national stage.
Right, so let's dive straight into the financial reality, starting with the headline numbers, and let's look at the revenue footprint.
Sure.
So for the first quarter, which ended April 1st, 2026, total revenue came in at $126.2 million.
Okay.
If we look back at the exact same quarter last year, Q1 2025, they were sitting at $119.2 million. That is a cool $7 million swing upward in top-line revenue for a single quarter.
Which is substantial. I mean, you have to contextualize that growth within the current environment, right?
It's not operating in a vacuum.
Exactly. Yeah. A $7 million top-line increase isn't just a byproduct of inflation. It represents genuine market share capture.
Nice.
Well, when the economic pie is shrinking for restaurants because consumers are, they're eating at home more often to save money.
Yeah, groceries are cheaper.
Right. So growing your slice of that shrinking pie means you are actively stealing customers from your competitors.
Wow. Okay. And breaking that down further, the company-operated restaurant revenue specifically jumped 7.6%, hitting $105.9 million.
Yeah.
But, top line is vanity and bottom line is sanity. Wall Street doesn't just care about how much money came in the front door.
No, they care about what's left over.
Exactly. They care about how much actually made it to the vault. So this brings us to adjusted net income, which hit $8.3 million. And when you translate that into earnings per share, or EPS, they posted 28 cents per diluted share.
What's fascinating here is the year-over-year comparison on that specific metric.
Oh, yeah.
In Q1 of 2025, their EPS was 19 cents. So they moved from 19 cents to 28 cents.
That's a massive jump.
Yeah. Right. We are looking at nearly a 50% increase in earnings per share. For a retail investor evaluating the stock, this is the ultimate validation signal.
Right.
It tells you that the revenue growth we just talked about isn't what analysts call empty calories.
Right. Empty calories meaning they didn't just spend an absolute fortune on marketing to temporarily boost sales, only to lose money on the actual operations.
Exactly. Sometimes a company will aggressively discount their food or, run an outrageously expensive national television campaign just to pump up their top-line revenue numbers.
Just to satisfy Wall Street's demand for growth.
Yeah, exactly. But when you look at the EPS later, you realize they actually lost money on every new customer they acquired.
Right.
El Pollo Loco did the exact opposite here. They grew revenue, and the flow through to the bottom line was incredibly strong.
Which brings us to the key performance indicators. Because, well, EPS is the destination, but the operational metrics show us the engine that got them there. System-wide same-store sales climbed 5.8%. And then Ira Filth dropped a number that honestly made me double-take. He said restaurant-level margins expanded by 320 basis points, landing at an absolutely massive 19.2%.
Let's translate the mechanics of that for a second for the listener.
Yeah, please.
When Wall Street talks about basis points, 1 basis point is 1/100th of a percentage point.
Right.
So 320 basis points is exactly 3.2 percentage points. They improved their profit margin at the actual physical restaurant level by 3.2% in a single year.
Which sounds small to a layman, but
It's huge. To understand how difficult that is, you have to look at the restaurant business model. It is notoriously unforgiving.
razor-thin margin.
Razor thin. You are dealing with perishable inventory, highly variable labor costs, unpredictable foot traffic. Executives will fight tooth and nail for a fraction of a percent.
Yeah.
So to expand your margin by over 3% in 12 months is, well, it's practically unheard of in a mature brand.
Right, but this is where I have to push back a little bit and play devil's advocate.
Okay, let's hear it.
Because as impressive as 19.2% sounds, we already established at the very beginning of our conversation that their effective price increase versus 2025 was 4.6%.
Yes, they did raise prices.
So wait, are we really looking at operational brilliance here? Or are they simply padding their margins by squeezing the consumer at the drive-through window?
That's a fair point.
I mean, if my grocery bill goes up 5% and a restaurant just hikes their prices by 5% to cover it, they maintain their margin. If they hike it by 6%, their margin expands. But eventually the consumer breaks, right?
Right. And it's the most critical question an investor should ask, honestly, because margin expansion driven solely by price hikes is a house of cards.
It has an expiration date.
Exactly. If you rely on price increases to drive profit, you eventually price yourself out of your demographic entirely. But if we connect this to the bigger picture, the traffic data completely invalidates that fear. Well, this is the crux of the bull thesis for El Pollo Loco right now. They raised prices by 4.6%, but system-wide traffic, the actual number of human beings walking into the store or pulling up to the speaker box, turned positive.
By how much?
It went up by 0.6%.
Wait, so they charged more and the frequency of visits actually increased?
Yes.
How is that mechanically possible when Liz Williams explicitly noted on the call that their core consumer is highly pressured by elevated energy and gas prices?
Two things are likely happening here. First is the concept of inelasticity.
Okay, lay that out for us.
It means the consumer perceives the value of the product, specifically the quality of fire-grilled fresh chicken compared to a frozen deep-fried patty, to be high enough that they will absorb a 50-cent price hike without abandoning the brand.
They view it as a worthwhile premium.
Exactly. They don't feel cheated. And the second thing, the trade-down effect. This is a massive macroeconomic trend right now.
I've been seeing this everywhere.
Right. Imagine a family of 4 that usually goes to a casual sit-down restaurant on a Friday night, like an Applebee's or a Chili's.
Right.
With inflation, that meal plus tip suddenly costs $80 or $90. They feel the pinch, so they trade down.
They don't want to spend $100 on a random Tuesday.
Exactly. But they don't want to trade all the way down to the bottom tier ultra cheap fast food either. They still want a meal that feels wholesome.
Right, a real meal.
And El Pollo Loco sits perfectly in that middle ground, often called fast casual. It feels like a real meal, but at a fast food price point. So while they might be losing a few highly price-sensitive customers at the bottom, they are more than making up for it by capturing these trade-down customers from higher-tier restaurants.
Oh, wow. That makes total sense. They're catching the refugees from the casual dining sector.
That's a great way to put it.
But even with a 0.6% traffic bump and a 4.6% price hike, the math on a 320 basis point margin expansion still doesn't fully equate for me. No, I mean, you can't squeeze 3.2% of pure profit just from that.
Yeah.
There has to be aggressive cost containment happening under the hood, right?
Absolutely. Ira Filth's breakdown of the expense column was clinical. Let's look at the food and paper costs for a second.
Let's do it.
In a year where commodity inflation was still a factor specifically, they faced about 70 basis points of raw commodity inflation. Their actual food and paper costs as a percentage of company restaurant sales decreased.
Decreased. By how much?
By 30 basis points to 24.9%.
Wait, how do your raw ingredients get more expensive, but your overall food cost percentage actually drops?
Well, partially because the 4.6% menu price increase structurally outpaced the inflation of the raw goods.
Okay.
But more importantly, it points to internal supply chain discipline.
Like less waste.
Exactly. Less food waste in the kitchens, better inventory forecasting. If you are throwing away less expired chicken at the end of the night, your food cost percentage drops drastically, regardless of the wholesale price of poultry.
Right. Which brings us to the elephant in the room for any business operating heavily in California right now. Labor.
Oh, yeah.
Because California just enacted massive minimum wage hikes for fast food workers. I mean, every single headline over the last year has been about how labor costs are going to obliterate restaurant margins on the West Coast.
It's been the dominant narrative.
So how on earth did El Pollo Loco navigate that?
This is perhaps the most impressive operational feat of the quarter, honestly. Labor and related expenses as a percentage of sales actually plummeted.
Plummeted?
Yeah, they dropped by about 260 basis points year over year, landing at 30.1%.
I'm sorry, labor costs went down by 2.6% as a percentage of sales. How is that even possible in California?
Well, they did experience wage inflation, but it was a highly manageable 0.4% during the quarter.
Okay, so they held the line on wages mostly.
Right. They had already priced in a lot of the structural wage increases earlier, but the secret weapon here wasn't just holding wages steady. We have to talk about operating leverage.
Okay, let's break down operating leverage for the listener, because it sounds like financial alchemy, but it's actually a very physical mechanism in a restaurant.
It is. Think of a restaurant like a factory line. You have fixed costs and variable costs.
Right.
The rent on the building, the property taxes, the base level of electricity, and the minimum number of staff required to simply open the doors, say a manager, a cashier, and 2 cooks.
You need those people just to legally operate.
Exactly. Those are fixed costs. You pay them whether you sell 1 taco or 1,000 tacos that day.
Right. If nobody shows up, you still have to pay the manager and keep the lights on.
Precisely. Now, once you sell enough food to cover those fixed base costs, your break-even point, the economics of the factory completely change.
How so?
Every additional customer that walks through the door is incredibly profitable because the overhead is already paid for.
Ah, I see.
You don't need to hire a second manager or rent a second building just to process an extra 20 orders an hour. So, because El Pollo Loco increased their comparable store sales by 5.4%, they pushed a significantly higher volume of cash through the exact same physical building using roughly the same base labor model.
And that is operating leverage.
That is operating leverage. The sales volume went up, so the labor cost, when measured as a percentage of those higher sales, naturally diluted and dropped.
It's like squeezing more productivity out of the exact same 4 walls.
Exactly.
But, Ira Filth also cited something else in the transcript that really caught my eye, and it's highly unusual.
What was that?
He mentioned that the margin expansion was also driven by unexpectedly lower health insurance and workers' compensation costs.
Oh, yes. That was interesting.
I mean, you almost never hear a CFO cite workers' comp as a primary driver for quarterly margin expansion. Do they automate the dangerous jobs or something? What's the mechanism there?
It is a rare and fascinating nugget. A drop in workers' compensation claims usually implies one of 2 things, and often both. First, it implies physical safety upgrades in the kitchen, better slip-resistant flooring, safer fryer splash guards, or redesigned ergonomic prep stations.
Make the kitchen physically safer.
Right. But second, and far more likely, it implies lower employee turnover.
Wait, how does turnover relate to workers' comp?
Because statistically, new employees who are unfamiliar with a fast-paced commercial kitchen are significantly more likely to burn themselves, slip, or mishandle heavy equipment than a veteran employee who has muscle memory of the workspace.
Wow, that makes total sense. They just know where things are.
Exactly. Furthermore, high turnover means you are constantly paying overtime to cover shifts, and fatigued workers make mistakes.
Right.
So the fact that health insurance and workers' comp costs are down suggests to me that El Pollo Loco is retaining its staff longer. The workforce is stabilizing. And a stable, experienced kitchen crew is inherently faster and safer, which directly protects the profit margin.
That makes perfect sense. So they leveraged their sales volume to dilute labor costs, and their operational stability reduced insurance overhead.
units exactly.
They even managed to completely offset the increases we saw in third-party delivery fees and higher utility costs.
Yeah, it was a clean sweep on the cost side.
So if the headline numbers show us a company that has successfully insulated its margins from macroeconomic chaos, the obvious next question is, what exactly are they selling that has consumers so willing to open their wallets?
Which transitions us perfectly away from the spreadsheet and directly into the kitchen.
Let's do it.
Because financial data is really just the shadow cast by human behavior. And Liz Williams spent a massive portion of the call outlining their strategic pillars, and the tip of the spear is their menu innovation.
So let's look at the actual food. Because in mid-February, they launched the Baja Double Tostadas.
Oh, yeah.
For anyone who hasn't seen the marketing for this, it features a double portion of their signature fire-grilled chicken, or seasoned shrimp, served in a massive crispy tortilla shell. And it's drizzled with a tangy lime crema sauce.
It looks incredible.
It does. And the sales data attached to this one specific menu item is staggering.
It really is. Williams reported that the Baja Tostada lineup exceeded all internal expectations, delivering a record-breaking 8.3% sales mix for the brand.
Okay, to put that in perspective for the listener, that means out of every single $100 spent at an El Pollo Loco anywhere in the country, $8.30 was spent exclusively on this new tostada.
That is immense concentration for a limited time offering.
That really is.
She also noted that the tostada and salad category as a whole peaked at over 20% of their total sales mix during the quarter.
Wow. 1 in 5 items.
Yeah. It was so undeniably successful that they made the strategic decision to keep the chicken Baja Tostada on the menu straight into the summer months.
Makes sense.
She explicitly referred to it on the call as a strong check-building opportunity.
Which is fantastic CEO speak. Let's translate check-building opportunity for a second.
Let's do it.
It means this item looks beautiful, it feels heavy, and it feels premium, which allows us to charge a higher price point. And more importantly, customers are happily paying it without feeling gouged. It's the psychological difference between selling a simple chicken burrito wrapped in foil versus serving a double tostada that looks like a composed dish you might get at a sit-down Mexican restaurant.
Exactly. It's premiumization. They are elevating the fast food experience into that fast casual tier we discussed earlier, which completely justifies the 4.6% effective price increase.
I see the connection now.
Right. If you just raise the price of a standard taco, the consumer feels cheated. If you raise the price but give them a double portion Baja Tostada, they feel like they are paying for culinary innovation.
But they didn't just target the premium salad demographic. They also went straight after the absolute jugular of American fast food culture, chicken tenders.
Yeah, the Loco tenders.
Right, in late April, they launched the Loco tenders, and they are aggressively marketing these. They're all white meat, boldly seasoned, designed to be highly portable finger food, and served with 3 signature dipping sauces: Baja Lime, House Ranch, and a proprietary Pollo Loco sauce.
Sounds pretty standard for the industry.
It does. So why tenders? They're famous for bone-in, fire-grilled chicken. Why pivot to the most crowded competitive category in fast food?
Because of demographics and the onboarding ramp.
Explain that.
During the Q&A segment of the call, an analyst named Jeremy Hamblin from Craig-Hallum asked about these tenders and how they're pricing them relative to massive competitors like Raising Cane's or Chick-fil-A.
Tough competition.
Very tough. And Liz Williams gave a very telling answer. She explained that the tenders are designed as a vital traffic driver, specifically targeted at new, younger consumers.
Right. Because if you are a teenager or a family with young kids, dealing with bone-in chicken can be, well, it can be messy.
Yeah, it requires sitting down. It requires 2 hands.
Exactly.
Bone-in, fire-grilled chicken is delicious, but it can be intimidating or simply inconvenient for a generation raised on nuggets and tenders.
Absolutely.
A chicken tender is universally understood. It is highly portable. You can eat it in the car with 1 hand. By introducing a high-quality tender, El Pollo Loco lowers the barrier to entry for someone who has never tried their brand before.
It's a gateway drug.
Exactly. Once they are in the door for the tenders, you can eventually cross-sell them on the burritos or the tostadas. It's a strategic customer acquisition tool.
And the way they executed customer acquisition for this tender launch was completely unorthodox for a 50-year-old legacy chicken chain.
It really was.
I mean, they didn't just buy a billboard on the highway and run a 30-second TV spot during a baseball game. They went to Coachella.
Yes. Specifically, the Revolve Festival at Coachella, which is essentially ground zero for Gen Z influencer culture.
Right, they gave celebrities, VIPs, and mega influencers an exclusive sneak peek. They hosted a literal tender reveal party for lifestyle media to meet their executive chef.
It's brilliant.
And the return on investment was absurd. They generated over 2 billion social media impressions leading up to the launch day. 2 billion.
That figure is just, it highlights a complete ground-up modernization of their marketing apparatus.
Yeah.
Liz Williams stated that this combination of bold flavors and bold activations is their winning equation going forward. They are moving away from traditional, expensive broadcast advertising and leveraging user-generated content.
Because it works.
It does. When an influencer at Coachella posts a video eating a Loco tender, it builds immense social momentum and cultural relevance. They aren't just selling a piece of fried chicken, they're selling a lifestyle aesthetic.
Which perfectly tees up the next major pillar of their strategy, the loyalty program.
Right, the app.
Because once you get that Gen Z customer to see the Coachella post, how do you capture them? You get them to download the app. And as I was reading through the transcript detailing their digital strategy, I couldn't help but draw a direct analogy to sneaker culture.
Oh, interesting.
Think about Nike or Supreme. El Pollo Loco is executing an exact replica of the limited edition sneaker drop playbook.
You're referring to the Loco Friday drops?
Exactly. They launched this program originally as a tribute to their 50th anniversary, but the consumer psychology worked so flawlessly that they kept it fully alive for 2026.
Yeah.
Every single Friday, they drop a one-day only offer. It might be early access to a new menu innovation or, a massive discount on a fan favorite combo.
And Liz Williams explicitly used the acronym FOMO, fear of missing out, when describing the strategy to Wall Street.
She said that.
She did. They're deliberately engineering psychological urgency.
It's brilliant mechanics. If I get an email saying burritos are $5 this month, I have 30 days to make a decision.
Right, you'll put it off.
There is no urgency, I forget about it. But if I get a push notification that says, secret menu item drops today only, offer expires at midnight, I have to open the app today.
To fact now.
I have to figure out my lunch plans today. It forces immediate, highly condensed foot traffic. You aren't just deciding you are hungry, you are actively responding to an expiring digital event.
The financial return on this gamification is staggering. Williams noted on the call that they achieved a 30% increase in revenue specifically derived from these targeted Digital Friday drops.
30%, that's huge.
If we connect this to the bigger picture, you start to see how El Pollo Loco is building a self-sustaining digital flywheel. Digital sales now account for approximately 28% of their total corporate restaurant sales, which includes their in-store kiosks.
And once someone is in that loyalty ecosystem, the behavioral data they generate is a goldmine.
Absolutely. Because of these personalized offers, the FOMO-inducing drops, and the highly segmented messaging based on individual purchase history, they have driven loyalty member frequency up by 13% over the trailing 12-month period.
Wow.
That means the people who use the app are visiting 13% more often than they did last year.
And they aren't just coming more frequently, they're spending heavier when they arrive.
Exactly.
The transcript shows member spend is up over 17% year over year. They've even introduced seasonal limited time offers that are gated based on your membership tier.
Right, the booths.
They call these tiers booths.
Huh.
The higher your status in the app, meaning the more money you've spent with the brand, the better the booth you get access to. It's status signaling built into a fast food app.
It's so smart. Look at their National Burrito Day activation in early April. By leaning heavily into this digital ecosystem, that single activation resulted in the highest loyalty sales day in the entire history of the company.
Incredible.
They're also tying these programs to massive cultural events outside of their own four walls. They launched a Coca-Cola El Pollo Loco Soccer Challenge, offering VIP trips to the Major League Soccer All-Star Game in Charlotte.
That one big.
This goes so far beyond a paper punch card that gives you a free taco after 10 visits. They are engineering a lifestyle brand ecosystem that psychologically incentivizes high-frequency, high-ticket behavior.
But here is where it gets incredibly real, though.
Where's that?
You can have the most brilliant marketing team in the world. You can throw the best Coachella influencer parties, and you can code the most addictive gamified app on the App Store. But if that push notification successfully sends 1,000 extra people to a physical drive-thru at noon on a Friday, and the kitchen falls apart under the pressure, your brand is dead.
The friction point.
Exactly.
Yeah.
You just paid marketing dollars to give people a terrible, slow experience. So how is the physical restaurant, the actual human beings in the kitchen, handling this digital surge?
That is the multi-million-dollar operational question. It is the friction point where digital ambition meets physical reality.
Yes.
And it's where Liz Williams' focus on what she calls the hospitality mindset pillar comes into play. Because they're managing this volume not with flashy robots, but through deeply unglamorous, highly granular back-end technology upgrades.
Like what?
We are talking about the exact science of making fast food faster and, more importantly, more accurate.
Oh, this is my favorite part of the Q&A session. An analyst named Matt Curtis from D.A. Davidson asked specifically about throughput, which is industry jargon for how many cars you can push through a drive-through per hour and speed of service. And Williams gave a profoundly telling answer. She said that before management even worried about raw speed, they had to ruthlessly fix accuracy.
Accuracy first.
To quote her directly, "You can tell me if you're fast, but if the order is wrong and you get home and you don't have what you want, it's a terrible experience, and you would prefer to have waited that extra couple of seconds for your order to be right."
It is profound operational wisdom, and it often gets lost in the QSR space where everyone is obsessed with shaving 3 seconds off a drive-through timer.
Right.
A fast error is still a failed transaction. To fix this, they had to completely overhaul the tools the kitchen staff uses. They completely redesigned how orders are visually displayed on the kitchen display screens, the KDS.
Screens above the cooks.
Exactly. They physically reconfigured the point of sale, or POS, keys on the cash registers to streamline the ordering process and reduce the cognitive load on the cashiers.
Let's really dig into the mechanics of that. Because to a retail investor, reconfiguring POS keys sounds like IT maintenance. It sounds totally trivial.
It's not.
No, it's not. Let's look at the anatomy of an error. Let's say you have a confusing button layout on the register screen. It's Friday lunch rush. A cashier is trying to go fast and accidentally hits the wrong modifier button.
Happens all the time.
The KDS screen in the back tells the cook to make a chicken burrito without guacamole instead of with guacamole. The cook makes it exactly as it appears on the screen. The bag is handed to the customer.
And the cascade of failure begins.
Exactly. The customer drives away, gets to their office, bites into the burrito, and realizes it's dry. No guacamole.
And they are furious.
Furious. They drive back to the restaurant, they walk inside, bypass the line, and loudly complain. Now the manager has to intervene.
Everything stops.
The kitchen line has to stop what they're doing to remake the food immediately, which backs up the orders for the 10 cars currently waiting in the drive-thru.
Yeah.
You have now wasted the raw ingredients of the first burrito, you've burned labor time making it twice, you've slowed down throughput for everyone else, and you've likely lost that customer for life because they don't trust your accuracy.
That one bad button press destroys speed, incinerates inventory, and ruins customer retention.
Yes.
By investing capital into fixing the UI and UX of the KDS and the POS systems, they are literally engineering errors out of the system before they can happen. It reduces the mental fatigue on the teenager tapping the screen, which speeds up order entry.
They also mentioned instituting enhanced training protocols, like forcing team members to triple check every single order before it goes into the bag.
Which is crucial.
They were testing enhanced, highly visible product labels on the packaging. And crucially, they are testing consumer-facing order confirmation boards in the drive-thru.
Those are great.
So when you speak your order into the speaker, you can visually read it on a screen and verify it before you even pull your car forward.
Which puts the final quality assurance check in the hands of the consumer. If there's an error, it's caught at the speaker box taking 0 seconds to fix rather than at the window where it takes 3 minutes to remake.
Exactly.
By improving this order accuracy, they prevent costly remakes, which directly protects that 19.2% restaurant-level profit margin we dissected earlier. It all connects.
A closed loop.
Right. A correct, satisfying order drives the repeat business that fuels the 0.6% traffic bump. The influencer at Coachella generates the app download, the app generates the Friday drop FOMO, the customer arrives, the POS is streamlined, the KDS displays it perfectly, the order is triple checked, and the customer leaves happy, ready to return next week. It is a closed-loop operational victory.
That is the complete anatomy of a successful quarter right there. They proved their model works under current conditions.
They did.
But as retail investors, we don't buy a stock for what the company did yesterday. We buy it for the cash flows it is going to generate tomorrow.
Looking ahead.
Which brings us to the most forward-looking part of the earnings call, management guidance. What is the executive team explicitly telling Wall Street analysts to expect for the remainder of 2026? Are they projecting caution, or are they stepping on the gas?
The loudest signal any management team can send to the market is an upward revision of guidance.
And did they?
Oh, yes. And the most important takeaway for any investor listening today is that Liz Williams and Ira Filth aren't just taking a victory lap for a solid Q1. They're actively raising their full-year expectations based on the momentum they are seeing right now.
That implies massive internal confidence.
That implies massive internal confidence in their operational data.
Let's hit those upward revisions hard, because they are the lifeblood of stock valuation models.
Okay, let's look at the numbers.
Ira Filth took the mic and laid out the new metrics. First, they increased their system-wide comparable store growth target. They now explicitly expect growth to be between 2% and 4% for the full year.
Right, up from their previous guidance.
Remember, they just posted 5.8% for Q1. And Filth noted that the second quarter to date, meaning the data they were seeing through late April, just before the call, was already running at 4.8%.
So they have momentum.
So they are guiding for a sustained, highly healthy, mid-single-digit growth rate despite the macroeconomic headwinds.
More importantly, for the valuation of the company, they bumped up their profit expectations. They increased their adjusted EBITDA target to a range between $67.5 million and $69.5 million.
Let's break down EBITDA for the newer investor, because it's a term thrown around on every financial network, but rarely explained in plain English.
Good idea.
Earnings before interest, taxes, depreciation, and amortization. Why do analysts care so much about this specific acronym?
Because EBITDA strips away the accounting noise.
Okay, what kind of noise?
It removes the impact of financing decisions, like how much debt the company has and the interest they pay on it. It removes tax environments, which can fluctuate wildly. And it removes non-cash accounting expenses, like depreciation of the physical buildings.
Got it.
What you are left with is a highly accurate measure of a company's core operational cash flow. It answers the fundamental question. Is the actual business of selling chicken generating hard cash?
Right.
Raising that target means management is highly confident that their cash engine is accelerating, providing them with more ammunition to reinvest in growth or return capital to shareholders.
And what about those legendary restaurant level margins, the ones that hit 19.2%? Did they raise the bar there too?
They did. Filth stated they expect full year 2026 restaurant level margins to be between 18.25% and 18.75%.
It's a bump.
That is an increase of 25 basis points from their prior, more conservative guidance. Now, it is crucial to note the nuance in Liz Williams' commentary here.
What did she say?
She was careful to manage expectations, noting that their focus is shifting slightly. They are moving away from trying to drive massive year-over-year margin expansion and are now focused on simply maintaining this incredibly healthy 18% to 20% range.
Wait, why cap the margin expansion? If you can get to 22%, shouldn't you try?
Because at a certain point, squeezing the margin further means you are starving the business. If you cut labor too deep, service suffers. If you use cheaper ingredients, the food suffers. By settling into a sustainable 18% to 20% range, they generate immense cash, which they plan to reinvest into strategic initiatives like more Coachella activations, deeper app development, and crucial physical technology upgrades.
Which naturally brings up the physical growth pipeline, because you can only squeeze so much efficiency and margin out of your existing footprint. Eventually, to grow the total enterprise value, you have to pour new concrete and open new doors.
You have to expand.
And El Pollo Loco is sticking to its aggressive development plan to open 18 to 20 new restaurants this year. That breaks down to roughly 3 to 4 company-owned locations and 15 to 16 franchise locations.
Right.
But the raw number of stores isn't the real story here. The geography is. Management stated that roughly 75% of these new openings are expected to be located outside of California.
This is a monumental pivot for the company and arguably the single most important variable for their long-term stock trajectory.
It's huge.
Historically, El Pollo Loco has been an aggressively West Coast, California-centric brand. Their entire cultural identity and their supply chain is anchored there. But operating a restaurant in California in 2026 is an incredibly hostile proposition.
Oh, without a doubt. You're dealing with sky-high commercial real estate costs, a brutal regulatory environment, heavily mandated labor cost increases, and massive utility inflation.
Exactly. The cost of doing business in California artificially suppresses their profitability. By pushing 75% of new development out of state, they are attempting to prove to Wall Street that this brand has national legs.
They want to break out.
They are trying to show that their food translates to different demographics and that they can operate in much friendlier regulatory and tax environments.
But expanding a fresh food concept geographically isn't like expanding a software company. You can't just flip a switch and open in Texas. There are massive supply chain logistics involved.
Bless you.
El Pollo Loco is famous for fresh, never frozen chicken that requires complex marination. How do they support stores 3 states away from their core distribution hubs?
That is the invisible risk factor. If you sell frozen burger patties, you can ship them across the country on a freezer truck and they sit in a walk-in freezer for weeks. It's logistically simple.
Right.
But El Pollo Loco's value proposition is fresh, citrus-marinated chicken, fire-grilled in front of the customer. Fresh poultry has an incredibly tight supply chain radius. It spoils quickly. To open heavily in places like Texas, Colorado, or Utah, they are having to build entirely new, localized spoken hub distribution networks. They have to find local poultry suppliers that meet their quality standards. It requires massive logistical execution.
And to mitigate the financial risk of this expansion, they are employing a very specific real estate strategy. Management noted on the call that roughly 75% of these new builds, both inside and outside of California, will benefit from being what they call second-generation sites.
Yes.
Let's unpack second-generation sites for the listener, because while it sounds like real estate broker jargon, it is actually a massive capital expenditure advantage for the company's balance sheet.
It is a brilliant capital allocation strategy. A first-generation site is essentially a patch of dirt.
Just an empty lot.
Right. You have to secure the zoning, run the municipal plumbing and electrical lines from the street, pour a massive concrete foundation, build the physical shell of the building, install underground grease traps, build out the heavy-duty HVAC ventilation systems, and pave the drive-through lanes.
That sounds expensive.
It is incredibly capital intensive and can take over a year to complete.
A massive cash burn before you even sell a single piece of chicken.
Exactly. A second generation site means you are taking a lease on a building that was already operating as a restaurant.
Ah, right.
Maybe a regional burger chain went bankrupt, or a coffee shop vacated the premises. The heavy lifting is already done, the grease traps are buried in the floor, the drive-through window is already cut into the exterior brick. The massive, expensive commercial ventilation hoods are likely still hanging in the kitchen ceiling.
So the timeline and the budget shrink exponentially.
Drastically. You go in, rip out the old decor, remodel the dining room to fit the El Pollo Loco branding, drop in your proprietary fire grills and POS systems, and you can open the doors for a fraction of the cost and in a fraction of the time.
So they are expanding aggressively into new, less expensive geographic markets, and they are doing it in a highly capital-efficient way by cannibalizing failed restaurant sites. That explains perfectly why their capital spending guidance for the entire year is remaining remarkably steady at between $37 million and $40 million. They are funding significant footprint growth without blowing out the budget or taking on massive debt.
And we also need to look at how they are projecting the macroeconomic headwinds for the remainder of the year, because predictability is what Wall Street craves most.
Yeah.
Earlier, we discussed how they outran inflation in Q1. Ira Filth translated the inflation guidance for the rest of 2026, and it is highly reassuring. Management explicitly expects commodity inflation to stay in a very manageable 1.5% to 2.5% range for the full year.
Okay.
Similarly, they expect wage inflation to hover in that same 1.5% to 2.5% window.
That provides investors with such clear, unobstructed visibility. It means that the kind of unexpected massive cost spikes we saw in 2022 and 2023 across the entire food sector aren't likely to suddenly reappear and devour these newly expanded profit margins.
Exactly. No surprises.
They have a clear line of sight on their costs, they have proven pricing power on their menu, and their physical operations are dialed in.
Furthermore, when an analyst asked about their strategy for menu pricing going forward, Filth noted a very strategic shift.
What's the shift?
They will actually see a step down in the pricing they are carrying for the balance of the year. They anticipate dropping to an effective price increase of about 3% or 3.5% in Q2, with only a small 1.5% targeted price increase scheduled for mid-year.
Wait, why ease off the gas pedal? If the consumer is absorbing the 4.6% hike now, why not keep pushing it?
Because they recognize the fragility of the consumer. They don't need to squeeze the consumer as hard right now because the sales volume and the back-end operational efficiencies are carrying the weight of the margin.
So they're playing the long game.
By easing off the price hikes, they offer a stronger value proposition to the customer, just as competitors might be forced to raise their prices to cover inefficiencies.
Right.
It's a defensive moat that protects their long-term market share.
So we have dissected the architecture of this quarter. We've looked at the headline financial numbers, the psychological check building of the menu innovation, the sneaker drop digital strategy, the granular operational fixes in the kitchen, and the highly confident forward guidance.
We've covered a lot.
It is time for the final verdict. So what does this all mean? I am asking you for a definitive, opinionated stance for the retail investor who is either holding El Pollo Loco in their portfolio right now or actively eyeing it for a potential entry point.
From a pure fundamental analysis standpoint, looking at the mechanics of the cash flow and the strategic execution, I have to take a strong bullish stance on El Pollo Loco following this Q1 2026 earnings call.
Bullish, okay.
The data presents a business that is not just surviving a hostile macroeconomic climate, but is actively and successfully executing a complex brand transformation.
I am fully aligned with that bullish thesis. When you pull back and look across the broader quick service restaurant landscape right now, it is a bloodbath.
It really is.
You see massive, deeply entrenched legacy competitors experiencing brutal, sustained traffic bleedouts. Consumers are utterly exhausted by inflation. They are flatly rejecting the value proposition of a fast food meal that costs as much as a sit-down diner.
Yeah.
Yet, amidst that chaos, El Pollo Loco has empirically proven through their Q1 data that they possess a rare combination: the pricing power to maintain their margins and the culinary relevance through things like the Loco Tenders and the Baja Tostadas to actually grow their total customer base simultaneously. Is a highly investable profile.
However, any seasoned investor knows that you never just buy a stock, put it in a drawer, and go to sleep.
No, you have to watch it.
A thesis is a living thesis. It must be monitored. If you are deploying capital into the stock based on this earnings call, here's highly actionable advice on exactly what you need to watch next. You must aggressively monitor the geographic expansion data.
You mean the out-of-state push into places like Texas?
Precisely. The core California market is a known variable. It is highly optimized. They know exactly how to run a restaurant in Los Angeles, and they know the consumer palate there inside and out.
Right.
But the true test of El Pollo Loco's long-term enterprise value, the ultimate catalyst that will dictate whether this remains a successful but capped regional player or evolves into a massive national heavyweight with a premium multiple, will be the performance of those new out-of-state locations.
That's the make or break.
Liz Williams mentioned they recently opened a company-owned location in Dallas, Texas. She noted they are seeing a wide variety of sales volumes in these new markets, some extreme highs and some below average that require time to build brand awareness.
So if you are reading the Q2 or Q3 earnings reports later this year, what is the specific metric you are hunting for?
I'm looking straight at the unit economics and the average unit volume, or AUV, of the non-California stores.
AUV, got it.
If the brand identity, the digital loyalty program, and the fresh grilled chicken translate well to the palate and the wallet of consumers in Texas, Colorado, and eventually the East Coast, the growth ceiling for this stock lifts exponentially.
The market opens up.
The total addressable market explodes. But conversely, if the out-of-state stores struggle to gain traction, if they require massive margin-crushing marketing spend just to get Texans in the door, the valuation of the company will remain permanently capped by its California roots.
That is the perfect operational threshold to monitor. But as we wrap up this analysis, there is a larger, almost philosophical angle to this earnings call that I think investors need to grapple with.
Let's hear it.
We spent a massive amount of time today dissecting their digital strategy. They achieved a 30% revenue increase from essentially weaponizing push notifications through their Friday drops. They saw history-making record sales from app-exclusive seasonal tiers during National Burrito Day. Their most engaged members are visiting 13% more often and spending 17% more money, entirely driven by personalized algorithmic marketing.
The sneaker drop analogy holds up perfectly. It is the absolute gamification of the fast food consumer.
Exactly. So my question to you, the listener, as you evaluate where to put your money over the next decade is this: are we witnessing the slow death of traditional fast food as a purely culinary transaction?
That's a big question.
When you buy shares of El Pollo Loco today, are you actually buying shares in a company that sells grilled chicken? Or are you investing in a highly gamified, psychologically optimized digital data ecosystem that simply uses a chicken tostada as the physical fulfillment mechanism for a digital transaction?
This raises an important question, frankly. It's a phenomenal paradigm shift to consider. Because if the true intrinsic value of the company is increasingly tied to its software, its ability to generate behavioral FOMO on a Friday morning through a smartphone screen, rather than just the taste of its marinade, then the way Wall Street analysts value these companies could fundamentally shift. We could start seeing these digitally dominant QSR brands command the kind of high valuation multiples typically reserved for tech companies.
If they master the algorithm of consumer habit, the food itself almost becomes secondary. The food is just the tangible reward for playing the digital game.
And based on the 2 billion social impressions from Coachella and the record-breaking loyalty days, El Pollo Loco is currently playing that game exceptionally well.
Well, that circles us right back to our very first point today. The diagnostic landscape of corporate earnings is incredibly complex. It is not just about reading a revenue line item on a spreadsheet.
Definitely not.
It is a living, breathing organism comprised of consumer psychology, supply chain realities, labor mechanics, and digital behavioral strategy. But when you take the time to truly dissect the transcripts, when you strip away the polished corporate phrasing and examine the actual operational mechanics, the muddy waters start to clear, and the true trajectory of a business reveals itself. We want to thank you for tuning in to this special deep dive. Keep asking the hard, mechanical questions, keep digging deep into the data, and always look right past the jargon. Until next time.